Welcome to Retire Coast, where we discuss all things retirement, life on the Mississippi Gulf Coast, and your financial welfare. Bill Anderson, your host, is a serial entrepreneur having created many successful businesses and holds a real estate broker's license, speaks about personal experiences with each topic. Listen, learn, and improve the quality of your life.
Welcome again to retirecoast.com. I'd like to talk to you today about something very serious. This is an alert, okay? And again, ding, 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 ding. This is an alert. The Tax Cuts and Jobs Act of 2017 is going to sunset at the end of 2025. Now, we're at the end of 2023 now, and maybe you'll listen to this in 2024, sometime down in later 2024, but we're close. We're very close. Here is the problem with that Tax and Jobs Act of 2017 and the sunset date of the end of 2025 is that you will put more money out of your pocket, regardless of what your situation is, than you're putting out now. That tax change in 2017, which a lot of people were skeptical about, turned out to be a tremendous opportunity for people to keep more of their income and pay a much lower tax rate. A lot of things were put into that bill, and most of those things are going to go away at the end of 2025. The major thing that they did was to double the standard deduction, which means that many people, including a lot of seniors, no longer had to do the long form tax return with all of those itemized deductions and spend lots of money with tax preparers. Everything became simple because the total deductions that most people would have did not exceed the standard deduction. Therefore, that short little form that was created, including the senior form, made it so simple, and you paid a lot less in taxes. For those of you that are working on a W-2, you found out that you weren't putting in as much money out of your paycheck every month as you had been in the past. Now, you weren't getting back as much at the end of the year, but in the net result was that you paid far less taxes because the tax brackets dropped also. And for those of you that have children, there were benefits available for having children that didn't exist prior to the 2017 Act. For businesses, there were many opportunities for small businesses to save money, to do that in a way that they could accelerate the depreciation when they purchased products. Instead of waiting for 4 or 5 or 10 years, they were able to write it all off the first year. Many, 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 many benefits for us as individuals and also for small businesses that this tax change in 2017 occurred. What I mean by sunset is that in December of 2025, December 31st, for example, so the last tax year that you'll be able to use these advantages are 2025. Well, that means that you've got literally 2 full years in order to do a tremendous amount of estate planning if you assume that the government is not going to push this forward in another 5 years or 10 years. There's a good chance that may not happen. The bill was passed by a majority of Republicans. The Democrats didn't vote for it at all. The Democrats probably won't vote for this if they get into control of the Senate and the House. And I'm not being political here. I'm simply stating a fact. This was passed really by the majority of Republicans and signed into law by President Trump. It wasn't real popular to begin with, but it's been very popular all along now because people understand, as they've been filing tax returns for the last few years, that they've actually saved money over the way things were prior to 2017. And if you have any doubt about that, go back and take a look at your tax returns. Find out that in the 2018 tax return that you did, your CPA probably said, hey, look, we're just going to do the short form this year because we don't have all those deductions. Now, for some of you that live in really high-cost states, such as California, there was a bit of a hit there because there was a maximum that you could deduct for all taxes, for example, is $10,000. And for those of you that live there, you might be paying $20,000, $25,000, $30,000 in taxes, and you couldn't deduct all of it. But for the majority of people in the country, it was a better deal. And even those people were able to deduct a lot of things and save some money, not as much. They paid a little bit more, for example. But the fact is that this is going to sunset, and if it does sunset, it's going to cost you money. Now, there are things that you can do ahead of time if you think that the elected officials are not going to push this and approve it. One thing you can do is to write letters, emails, texts, Twitters, whatever you need to do to encourage them to renew, extend the Tax Cuts and Job Acts, TCJA of 2017. So maybe it goes to 2035, for example. You need to do that. If you can't do that, then you have to start looking at, if you're going to be withdrawing money from your 401k, for example, because you're over 59 and a half and you're eligible to do that without a fee, you have to stagger that. You're going to have to plan that, and you need to take some of that out because the taxes you're going to pay after 2025 for the year 2026 will be significantly higher on those withdrawals of any kind from any eligible plan that requires you to pay taxes on it, which would be something like the 401k or a standard IRA plan. You're going to pay more taxes. So the idea is you want to take out some of that money, if not all of it, before that period of time, and then roll that over into other eligible plans such as a Roth IRA or other kinds of plans where you can store your money and have it do the same thing it was doing for you prior to that. If it was invested in the stock market, you can still use these other tools to get it back into those markets and still earn some money. It's simply a matter of trying to cover your bases on tax liability before this plan expires. If you use a CPA, then contact your CPA and say, hey, we've got 2 years to work on this. The fact is that that's not a lot of time. You've got the rest of 2023, for those of you listening to it in 2023, so you can do some of it in 2023, 24, and 25 to spread this out. But if you have a lot of money in your 401k, several $100,000, you're going to end up costing yourself some big dollars in taxes if you don't start to remove some of that money now. And again, it's a plan. Don't just run out and start taking it out of there. You need to talk to some professionals about what to do and how to do it. There are some other tax advantages that are in that bill as well that you need to take a look at and see how they will impact you if this goes away in 2025. Based on everything that I've been seeing out there, and you have too, we all watch the news, we all see what's going on. We have an absolutely dysfunctional government, and I don't care what side you're on. Things aren't working right, and everybody is yelling at everybody else, and things are being pushed right to the edge. So if you expect for a moment that you're going to be taken care of on this, I think you're wrong. So I plan on the worst, and if the best happens, that's great. But in any case, you need to do that planning for your retirement. Also, if you are going to gift money to anyone, there was some provisions in there that'll be rolled back also that will cost you some money. And it doesn't make any difference where you're at, whether you're retired or you're working for a living now. There will be some negatives that you're going to have to deal with that you can plan ahead for now. So thank you for listening to this. I'm sorry to bring you this, what I think is kind of bad news. We all thought that this would expire at 2025, but that there might be some discussion at least by this time whether we can move this forward with the legislative process and get it extended. And so far, it doesn't seem like any of the elected officials really want to talk about this. There have been a number of articles written by various newspapers and Kiplinger, for example, I'm looking at an article that's pretty good that explains about the tax brackets and the standard deduction that went from 13,000 to 24,000. It's actually higher than that if you're a senior now, and it's indexed. That's another thing they did, is index it for inflation, which they hadn't before. Then the estate and the gift taxes, the individuals can currently transfer up to 12.92 million, and a married couple for 25 million. Now, for the vast majority of you listening, you go, I don't have that kind of money to transfer. But for those of you that do, it's something to pay attention to. And then the annual gifts that you can give are $17,000 a year, $34,000 for a married couple, and it was a lot less before. So if you want to gift some money to some of your relatives, you probably need to consider doing that before this goes away. The same situation with dynasty trusts and revocable insurance trusts. Lots and lots of activity out there that will be impacted if this sunsets and doesn't go back into effect. Well, thank you very much for listening to this episode of retirecoast.com podcast. Please go to our blog articles and read them on retirecoast.com. You'll find lots of articles there about a whole variety of things that deal with your life. Thank you.